Hello financial fans, welcome back to another stock analysis. Today we'll be covering Colgate-Palmolive, stock ticker CL. Colgate-Palmolive is a multinational consumer goods company that operates globally, focusing on oral care, personal care, and household products. With a wide range of popular brands like Colgate toothpaste, Palmolive dish soap, and soft soap body wash, they manufacture and distribute products that cater to people's daily hygiene and cleaning needs. The company is currently sitting at a market cap of $63.4 billion, and in 2022 they generated a revenue of $18 billion, and the dividend yield is currently sitting at 2.51%. 44% of their revenue comes from oral care, 20% from personal care, 18% from home care, and 18% from pet nutrition. To determine the final valuation of the company, we'll be using a margin of safety. Margin of safety will be based on the financial ratios, the financial health, and the growth of the company. I will be using a standard margin of safety of 25%, which can never go below 0%. The margin of safety can either increase or decrease based on the ratios that we're going to look at in just a moment, and the severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in a scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction from a margin of safety. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction from margin of safety. The first two metrics that we'll be looking at are the EBIT growth and the margin growth. The EBIT has gone down over the years, going from just over $4 billion in 2013 to $3.6 billion in 2022. The average EBIT decline during this period was 1.4%, which is a 5% increase in the margin of safety. The margin has also gone down over the years, going from 23.5% in 2013 to 20% in 2022. The average margin decline during this period was 1.7%, which is another 5% increase in the margin of safety. The next two metrics are the dividend growth and the payout ratio. The dividend has gone up over the years, going from $1.36 a share in 2013 to $1.92 a share in 2023. Annual dividend growth during this period was 3.5%, which is no change in the margin of safety. This with a payout ratio that is currently sitting at a very high 98.5%, which is a 5% increase in margin of safety since the dividend might not be safe anymore. The final two ratios that we'll be looking at are the debt to EBITDA and return on invested capital. To get a debt to EBITDA ratio, we have to take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debt. And for Colgate, this is just under 6 years, in this case a 585% debt to EBITDA ratio, which is yet another 5% increase in the margin of safety. The return on invested capital, however, for Colgate-Palmolive is sitting at a very nice 24.2%, indicating that the management is very effective at allocating capital, which awards them with a 5% deduction in the margin of safety on this metric. Let's go look at the valuation models next to determine the intrinsic value of Colgate-Palmolive. The first valuation model that we'll be using is the discounted cash flow model. I've imported the free cash flow of Colgate going from 2013 to 2022. The average growth rate in the free cash flow annually during this period was sitting at 1.6%, and I'm projecting an expected growth rate in their future free cash flow growth of 5% annually for the next 10 years, seeing as their free cash flow dropped a lot in 2022, I'm expecting it to rebound significantly. With this percentage, we'll determine the future free cash flow for Colgate and determine a terminal year of valuation using a perpetual growth rate of 3% and a discount rate of 8.5%. This gives us a sum of free cash flow of $37 billion, and to get an equity value, we have to add the cash and equivalents and subtract the debt, leaving us with an equity value of $12.7 billion. And dividing this by the amount of shares outstanding, we get a discounted cash flow price per share of only $15.42, which is almost a 80% downside from the current price. Wow, that's incredible. The second model that we'll be using is the dividend discount model. I've imported the dividend payouts of Colgate-Palmolive of the past 5 years. On average, it has been growing at 2.8%, and I'm projecting no growth in any of their future dividend payouts, seeing as their payout ratio is currently sitting at almost 100% of their net income. We'll also once again be using a discount rate of 8.5% in this valuation, and out of this model then, we get a price per share of only $22.59, as they cannot increase their dividends further anymore, at this point at least, which gives them a downside out of this model of 70.45%. The next model that we'll be using is Graham's Vice Valuation Formula. In this model, we take a look at the earnings per share that Colgate-Palmolive is generating, the growth rate estimate projected by Wall Street, and the current yield of AAA corporate bonds in relation to the average yield of AAA corporate bonds, always sitting at 4.4. And we go by the theory of Benjamin Graham that the PE of a company with no growth should never exceed 7. Looking at all of these metrics, we get a fair value of $26.74, which is a 65% downside from this model. The fourth model that we'll be using is the multiple valuation. In this model, we look at similar companies to Colgate, look at their stock price and their earnings per share. This way, we can determine the average PE multiple in the industry, which in this case is sitting at 34.74. All we have to do to get a fair value then is to multiply by the earnings per share that Colgate is generating, which is $1.91 a share, giving us a fair value of $66.35, which is a 13.2% downside out of this model. And the last model that we'll be using is the mean reversion theory. In this model, we go by the theory that a company will always trade above or below its mean, and the metrics that we use to determine this are the dividend yield and the PE ratio. I've imported the dividend yield of the past 5 years, and on average it has been sitting at 2.26%, while the current yield is sitting at 2.51%, indicating that it's currently undervalued on this metric. Doing the same with the PE ratio, of the past 5 years, on average it has been sitting at 26.12, while the current PE ratio is sitting at over 40, indicating that it's massively overvalued on this metric. This gives us a fair value of $67.43, which is almost a 20% downside from the current price. If you want to get access to all of the models I use in my videos and much more, you can check in the description for my Painter link. Anyways, getting that self-promotion out of the way, let's go look at the final overview of a valuation next. Looking at a final overview, we've imported the discounted cash flow, discounted dividend, Graham's valuation, the multiple valuation, and the mean reversion theory price per share, giving us an average of $39.71. On margin of safety, we've determined earlier using a standard margin of safety of 25%, adding 5% for the debt to EBITDA, EBIT growth, and margin growth, deducting it by 5% for the return on invested capital, and adding another 5% for the payout ratio, leaving us with a whopping 40% margin of safety. Applying this margin of safety, we get a fair value of $23.82, and with the current price of $76.44, we can only give a very big downside of almost 69%, indicating that it's currently a big sell. If there's any other companies that you would like to see me cover on this channel, please let me know in the comments. And thanks for watching.